In last week's analysis, we took a look at Intuitive Surgical, the market leader in the robotic surgical equipment space. Today, we look at a much less known company that Intuitive and basically all other companies in this market rely on when it comes to their simulation and training programs. Same as Intuitive, Surgical Science Sweden is bound to benefit from a young secular trend to robotic surgicals, but in contrast to Intuitive, they do have a more flexible business model, which also allows them better access to niches within this market. That also enabled them to grow 5 times as fast as Intuitive over the last 5 years, while still keeping a lower valuation. In this video, we will dig into the business model and the markets of surgical science, analyze the strategic position by doing a Porter's 5 forces analysis, and have a look at the latest financial statements to see how they are doing. We will also check their valuation and do a discounted cash flow calculation. In the end, we will see if surgical science is a good long-term investment for us or not. Here, I want to issue a warning though. As always, I am trying to find good and high quality businesses that are suitable for a stable long-term investment. Today, we are talking about a small cap company though, and the risks in this case are definitely elevated. I still find them a very interesting company to keep on your watch list. My name is Florian. Welcome to Cashflow Maniac. Let's jump in. Surgical Science Sweden has the ticker symbol of SUS on the Oslo Stock Exchange and SUSRF on the OTC. They are working in the healthcare equipment sector and were founded in 1999. At the moment they have 260 employees and their headquarters sits in Gothenburg, Sweden. The market cap sits at $845 million right now. The strategy of surgical science is to have 2 separated business areas. The first one is educational products that focus on customers in educational and training who actually uses the company's in-house developed simulators to increase the patient safety through effective and generic training. And that can be measured objectively. On the homepage of Surgical Science, we can see a couple of examples. Here we can see the educational product for the healthcare professionals. So here the upcoming doctors are training with the simulator. And down here we can also see the robotic surgery simulator. So these are not real humans they are training on, but basically training dummies. And here we can already see that surgical science has to work very closely together with the OEMs, the equipment manufacturers, and integrate their product-specific simulations into their products. In this business model, the customers usually have to pay a development fee in addition to the software licenses per unit based. The huge advantage of training with a simulator here is that basically the upcoming doctors can already increase their skills in the simulator without any risks for the patients. And when they come to the operating room, they have already developed their basic skills and the basic training and are better able and prepared to work with real-life patients. Here we can see that the training basically can be done without any risks for the patients, and that results to a almost 30% quicker performance during the first procedures on actual humans. Of course, a faster procedure means that it's less likely to make any mistakes, and the recovery time is also usually quicker. You can also see that the doctors are 5 times less likely to make any errors if they have had previous training with the simulator, and they are 9 times more likely to complete a successful procedure. So there are huge advantages for the customers of surgical science in order to convince the hospitals, the doctors, and the patients in the end that their robotic machines are safe and can actually make up for better procedures in the end. In the last company report, they mention a couple of customers from their side. For example, you can see here Intuitive, Medtronic, CMR Surgical, Johnson & Johnson, and Medicaroid, a Japanese company. They also mention that currently only 2 to 3% of the possible procedures are done with this robot technology. So there is still a lot of room to grow. Overall, their OEM business currently has 15 customers. So basically they are working with everybody who is preparing these surgical robots. And here on the screen, we can also see a list of the biggest customers at the moment. In their last company report, they actually point out the costs and the margins they have. And the two biggest cost points we can see here is one, cost of goods sold, and the second one is the research and development cost, which sits at about 20%. So here we can already see that Surgical Science is putting a huge focus on research and development to not only develop the best products on the market, but also to expand their already big product lineup and simulation lineup even further. Also, the operating margin they point out is 24% here, which was increased by 3% compared to the last quarter, which is also quite a good level. And actually the gross margin is almost 70% right now. But we will come to the financial numbers a bit later in this analysis. The company has offices and development sites all over the world, so they can cover more than 60 markets right now. And especially the American, the US, and the Asia market are very important for them. As European company, they actually state that the European market is their second biggest growth market right after the US. But the home market is usually a very strong market for most companies. The overall healthcare and medical simulation market is actually expected to grow even quicker for the already quickly growing market for robotic surgeries. Here you can see they expect a CAGR of 16% until 2028. And the major software types that are pushing this growth are actually simulation-based softwares, tutors, and also recording softwares. With their portfolio, Surgical Science actually is in a pole position to benefit from this market trend. When we look at the strategic position by doing the Porter's 5 forces analysis, first of all, I would estimate the threat of new entrants as low. There is a very specialized combination of know-how between simulation, robotics, medical, and also VR necessary to even enter this market. And especially the simulation of human tissue is very complicated to do. There are many different layers in the human body or human skin even that all have different properties, and they have to be simulated properly to make a good simulation that is worthwhile for the doctors in the end. Also, as we are working in the medical field, there are certain government regulations, and for new players, it is just not very easy to enter here. The threat of substitutes I would also estimate as quite low. We already saw that SUS is working with almost all of the robotic equipment manufacturers together. They have licensing deals, and this makes up for high switching costs, not only for the material and the simulation software, but if the users and the doctors have already had the training with these simulation software and they are used to a certain software, it is not so easy for them to switch to another one. The competitive rivalry I would estimate as high to medium. There are already big competitors that have knowledge in certain areas like CAE, Vertamid or Mentis. But none of them covers the whole area that Surgical Science does. Besides the simulation training, the doctors can also do the training on, for example, human or animal bodies, or they can do the training under real patients with the supervision of already trained doctors. So even though the competitive rivalry here is quite high, I think that the position of Surgical Science is still very strong. The bargaining power of the customers I would estimate as medium to low. We have already seen that Surgical Science is working with all major players in this field. They already have licensing agreements, and if you want to have a full solution all out of one hand, they are the only option on the market right now. The only reason why I didn't put only low here is that this is still a very young and very fluctuating market, and from my point of view it still needs to be proven if Surgical Science can also keep this advantage over the long run. The bargaining power of their suppliers I would estimate as medium. First of all, as mostly simulation and training software supplier, they do not have so many suppliers for this specific business. For the simulation hardware, they do need suppliers, and this equipment is usually also very specialized. There are not so many suppliers on the market for these specialized things. So in this region, their suppliers do have some pricing power, but we also saw already the cost of goods sold. And here it seems like Surgical Science can really keep this under control, and they could even lower it a little bit over the last year. Overall, the strategic position of Surgical Science seems to be quite strong. They do have a moat by working with all the OEMs together and by implementing their software and simulations to their machines already. So they definitely have an advantage against their competitors. It just needs to be seen if they can also keep this on the long run or if their competitors might catch up. Before we jump into the financial analysis now, if you do like the video so far, please consider leaving a like or subscribe. It would really make my day. When we look at the financial data now, one thing I need to remark, because this is a Swedish and small cap company, not all of the data is always available on homepages like Seeking Alpha or so. So the financial data I used for this is mixed together from the company reports, the last annual report and the last quarterly report, and also from different sites. So for example, for the total performance against the S&P 500, I needed to use my own plots from TradingView here because it's not available in accurate data on Seeking Alpha. So when we look at the 1 year performance of Surgical Science Sweden against the S&P, we can see that the 1 year performance is a bit worse compared to the S&P 500. They're still around 10% in the plus, and we had a huge run up by middle of the year, but by end of the year, the S&P 500 was stronger. The 5 year performance though looks totally different. Here we compare an increase of around 100% of the S&P 500 to an increase of more than 800% of Surgical Science Sweden. And if we look at the performance since the IP of Surgical Science versus the S&P 500, we can again see a huge performance of almost 2000% over these last 6.5 years. So they really did have a remarkable performance, but we can also see that since the heights in 2021, the stock has mostly traded sidewards. But even though the stock has traded sidewards, the fundamentals of the company have still increased over the same time frame. The operating profit and the net income is basically growing on a year-to-year basis, and especially since 2021, their performance has really picked up. The same is true for the net margin and the operating margin, which have also increased over the same time frame. And you can also see the estimation for the next years is that this growth trend in all of these aspects should still continue. The balance sheet also looks very clean. We can see that Market Screener doesn't put any leverage here. When I did the calculation actually from their last annual report and compared the long-term debt to the EBITDA, I came to a different number and I found that the long-term debt is about 0.4 times the EBITDA. So there is a little bit of long-term debt, but it is on a very, very low basis. The sales and the EBITDA of the company are also bound to increase very nicely over the next years. And when we check the free cash flow and the revenue of the company, we can actually see the same trend. Since 2021, the revenue as well as the free cash flow could increase very nicely. And when we believe the forecast of the company itself, this trend is nowhere near the end. While those numbers all look very nice and we can see a year-over-year increase in all of these numbers, in the last quarterly report, we can unfortunately see that the revenue trend actually is going down on a quarter-to-quarter basis within the last fiscal year of 2023. The overall number for the whole year is still much better compared to the last year, but in the recent quarters, we also saw a slight dip. Most of the dips actually comes from simulation and licensing revenue over the last couple of months, mostly related to the education sector. The service revenue and also the sales connected to simulators in the industry are still higher on a quarter-to-quarter basis, but we can also see that the service revenue only makes up about 10% and the development revenue only 6% of the revenue at the moment. So these are the smaller parts of their business. The cash flow trend over the last quarters is very nicely, and we can see here a significant increase over the last quarters. So even though the revenue was down a little bit, the cash flow went up. And one thing this is attributed to is that the accounts receivable on a rolling 12 months basis have decreased over the same time frame. One thing I definitely want to point out here is that the goodwill of the company since 2021 is quite high, makes up a significant part of their assets. In this case, this is due to 2 acquisitions in 2021 of Symbionics and Mimic Technologies. Due to these acquisitions, they have to consolidate especially the sales channels between their own sales channels and the sales channels of Symbionics. When they succeed in this, I would expect that first of all the goodwill comes down again over the next years, next quarters, And at the same time, they might be able to even increase their margins with this consolidation. But of course, at the moment, this is pure speculation and it needs to be seen if they really succeed in this. When we sum this up by using my checklist, we can first of all see that the revenue growth on a year-over-year basis sits at a whopping 20.7%, and the 5-year CAGR even sits at higher than 72%. For the net income growth, it looks similar. We have a year-over-year growth of 82% and a 5-year CAGR of almost 80%. The free cash flow growth in the year-over-year basis sits at almost 130%, and over the 5-year CAGR, it's 160%. Free cash flow yields, it's a little bit lower than I would like to see it. It's at 2.4%. So in this case, it gets a yellow checkbox from me. We also saw already that the company has very low debt. According to my calculation, it sits at 0.4 long-term debt against EBITDA. Surgical Science doesn't pay any dividends, so we can ignore this line for the time being. And for the margins and also the return of invested capital, we could see that Surgical Science could increase this on a year-over-year basis, and they also expect to increase this even at least over the next 3 years. So overall, we could see that this company over the last couple of years, they really picked up speed. They really could implement their business model. They really could find partners to work with, and this all reflected also in their growth numbers. Also very nice to see they could translate the revenue and their net income directly to an increase in the free cash flow. Before we come to our conclusion, let's also have a look at the valuation of the company. And maybe you noticed that I did not use the price to free cash flow in this case, mostly because the cash flow due to these acquisitions was all over the place over the last years. So I find it hard to get any valuable information from the price to cash flow. When we look at the PE and the EV to EBITDA multiples though, we can first of all see that in 2021, when the stock price was also at the highest, there was also significant increase in these multiples. So the increase in stock price was not backed by business growth. But since then, both of these multiples came down to much more reasonable values again. And right now we can see that the PE ratio sits at 39 and the EV to EBITDA at 40. This is definitely also not a very cheap valuation. But when we compare this to other companies in this space, like Intuitive Surgical, for example, it is on a much more reasonable level. Last but not least, let's estimate the fair value by using my discounted cash flow spreadsheet. And I plugged in the recent growth numbers here. And what we can immediately see here is that especially the valuation of the discounted cash flow model is insanely high in this case. Of course, this comes due to the very, very high growth numbers that we have. And I would also not expect the company to continue growing with these high numbers over the next 10 years. So first of all, in this case, I'll definitely increase my margin of safety to 20, or in this case, maybe even 30%, because it's very hard for me to estimate any accurate values here. And the second thing I would do is to go down with the free cash flow and also the net income growth rate. We saw that the secure trend, the market trend, is estimated to be at around 16%. And given the mode of the company and the very strong market position, I would give them maybe even a little bit higher growth rate compared to this market. So maybe let's estimate it for 20% in both cases. And if we do this, we come up to a fair value of around 27 US dollars, which is much more reasonable compared to the number that we just saw. With including my margin of safety, in this case of 30%, we come up to a fair value of around 19%. This still sits a little bit above the current stock price. As we don't have any dividends here, we remove the Gordon growth model, and there is no data for the Gordon growth model in here. It is a little bit tough in this case to estimate the fair value for the company, mostly because the growth rate over the next years is also very uncertain. So in this case, honestly, I would take this fair value calculation with a huge grain of salt. Surgical Science Sweden looks like a promising upcoming company in the surgical robotic space. Again, I want to point out here that this is a small cap company, and the risks are definitely elevated. I'd never advise anybody to invest in such a company, and if you still want to invest, I'd highly advise you to only do it with a very small position. But even though they are still a quite young company that is only profitable since a couple of years, they could already secure partnerships with all the major players in the robotic surgical equipment market, which gives them a good moat. And the company forecast, especially for this OEM business, will grow very strongly over the next years. They do have an unmatched portfolio for this simulation and training software and equipment, and their big focus on R&D has helped them to come to this point, and I think it will also help them to keep this advantage over the long run. In addition to this very strong organic growth, Surgical Science is also executing an M&A strategy, and they have acquired several companies over the last years. They are working in a market with a very strong security trend, and that should also help them to grow very nicely over the next years. The financials of the company do look good, with low debt and crazy growth numbers in revenue and net income that they could also translate to huge growth in their free cash flow. But the amount of goodwill is also quite high due to the acquisition of Symbionic and Mimic in 2021. And for these acquisitions, they actually also issued a lot of shares that have diluted their former investors. I definitely wouldn't rule it out that this might happen again in the future. The valuation right now, even though it's not cheap, seems quite reasonable for the growth numbers, but keep in mind that European companies are usually a bit cheaper valued compared to their US counterparts. Due to these high growth numbers, it is tough for me to estimate the fair value with a reasonable accuracy. So in this case, I wouldn't rely on this number too much here. Overall, I think that Surgical Science Sweden is a very interesting upcoming company that I'll definitely keep an eye on. Because of the risks that I pointed out already, I am currently not invested though. If you did like the video and if you did find the analysis helpful, please consider leaving me a like or even subscribing to the channel. Also, if you have any comments, any thoughts about the company itself, please leave them down in the comment section. I would be very interested in what you think about it. That being said, thank you so much for watching, guys, and see you next week.